It's been a month since our last property market update, and boy, has the market changed. So, in our regular Property Insiders show, today I want to have a chat with Australia's leading property economist, Dr. Andrew Wilson of My Housing Market, to find out what's actually happening in the property market. Welcome, Andrew.
Thank you, Michael. Yes, another month has passed, so we can, have a look at the tea leaves and see how they're panning out for our housing market.
Well, a month's passed, and
Yes.
I was going to say a new government, but it's actually the old government. Not that many
Yeah,
people
that's right.
expected it. Interest rate cuts. APRA has said they're going to loosen the screws. But today there was the latest GDP figures. How did they come out?
Well, they were better than they have been for the last 6 months, Michael. Of course, this was the March quarter data from on GDP from the ABS. 0.4% increase over the March quarter, better than the previous 2 quarters. But a closer look at the data is quite sobering. We can see really that GDP was sustained by government spending. But when we look at the main drivers of, the real economy, and that is consumption and particularly dwelling investment, they were down quite sharply again. And I think this is obviously the future to come, that dwelling investment will continue to fall, given how strong it's been through the apartment building boom, particularly over recent years. And of course, there's no lift in consumption. Of course, we're very fortunate, Michael. I'm sure you're aware that we've had a quite an amazing trade surplus numbers coming through recently. And this is because of record volumes and high prices for iron ore. And it's the export sector, the resource export sector in relation to iron ore, which is going to keep our economy ticking over. And that's a good thing for the GDP modelling and the numbers, but it's not going to create a lot of jobs in the first instance. This is the issue. We need job creation from those, local economic drivers.
So people are all excited about interest rate cuts. But if you look deeper, there's a reason why the Reserve Bank did it.
Yeah.
The main concern was that, as you say, our economy is not growing, measured by GDP. Wages aren't growing, inflation is not growing. So it's actually not such good news at all, is it, Andrew?
Well, it's not, Michael. And this has been a change, not just with our Reserve Bank, but with the Federal Reserve in the US. And the Reserve Bank also was forced in the end, in my opinion, to act to stimulate the economy, because the real data coming through was clearly showing that their position, as it has been for a number of years now, was not going to be the outcome. That is an increase in interest rates through higher inflation and higher wages. So they're now, switching to that real data model in terms of where they're going to set their interest rates into the future. And that probably means more than likely another cut this year. I'm not an advocate for any more perhaps than this cut, and maybe one more. I think that we get under 1%, it becomes a self-negating process. We've seen a lot of advanced economies push their interest rates down to zero after the GFC, which is over 10 years ago, Michael, and they've struggled to get it above that in that period of time. We don't want to fall into that trap. We need to keep something in reserve and look at other mechanisms to stimulate the economy.
Well, there's a number of other ways one can stimulate the economy. You can do quantitative easing, which some countries have done, which is put more money into the system, or you can stimulate it by giving first homeowner grants. Remember the pink bats they gave years ago, or other incentives. Well, one of the things the Liberal government, the coalition government, is trying to do is get our budget into surplus. While that may be a nice ideology, maybe another way of looking at it is to actually spend some money when interest for them is at the lowest rates it would be if they were to borrow a little bit more or not get into surplus, and they could use that to stimulate and grease the wheels of industry.
You're right. Let's not be too fixated on significant budget surpluses. I think we're still in a reasonable position, Michael. The whole point of if our GDP went backwards and perhaps we moved into a technical recession, and that's 2 quarters below in negative territory in consecutive quarters. Last time we had that was, of course, the early 90s. But given our current circumstances, we're going to see it, even if we had that technical recession, we'll see a completely different environment. This is an incomes recession, not a jobs recession, which we saw in the early 1990s, where unemployment was well over 10%. Over 13% down in Melbourne or in Melbourne. So it would be different.
Okay, let's have a look at how our housing markets are performing. Now, you look at asking price indexes as opposed to selling price indexes.
Yeah.
We've discussed that before, but in my mind, it's a more real-time,
Yeah.
accurate assessment of what's going on. So how are you seeing the housing markets around Australia at the moment, Andrew?
Well, we've had some recent reports from other price modelers, Michael, which show that even though prices are still declining, the rate of decline is certainly now easing. And I think that maybe we could start speculating that we can see the bottom of the market now. I think that certainly there's a lot more positivity. I think that we'll see the bottom of the market, as I've always said, this year in terms of price declines, particularly, of course, given that we've had an easing of those restrictive lending practices, and also what the interest rate settings were also restricted. Asking prices for the month of May shows a similar result to the other data models. Prices are down. Asking house prices are down, plus or minus around 1% over the month. Of course, these monthly numbers do tend to be volatile, and it's more about the trend rather than the actual headline number.
Now, auction clearance rates are another good
Yes.
indication of market sentiment,
Yes.
particularly in our two big capital cities, Melbourne and Sydney, and they seem very positive since the election.
Well, they have, Michael. You're right, and we've seen a real change through May in auction clearance rates. Of course, auction clearance rates started the year well above where they were at the end of last year, which was at record lows, around 40% in both Melbourne and Sydney, and they pushed up a high 50s, low 60s, high 50s in Melbourne, low 60s in Sydney. But over the last month, we've seen auction clearance rates moving into the mid 60s. The last weekend, or first weekend in June, we saw the highest auction clearance rate in Melbourne for the year, and one of the highest in Sydney. They're now in the mid 60s. Of course, we do know that higher auction clearance rates reflect higher prices and more activity in the market. It's logical, and it is a very reliable forward indicator in Melbourne and Sydney.
I agree with you. We're getting close to the bottom. I know privately we've both spoken that there's not going to be a big boom, but it's a good idea to, if you're going to buy your home or you're looking at investment, to get a counter-cyclical opportunity, and probably the counter-cyclical opportunity for a long time. But you've also got to have realistic expectations. It's not going to be the same. We're not going to have double-digit growth this time around, are we, Andrew?
No, we're not, Michael. And there's also the counter-seasonal effects of midwinter buying, Michael. But I think that we certainly have not a wave of confidence, but we have more confidence in the market. We will see more buyers, and eventually that'll mean higher prices.
We're noticing that with inquiries at Metropole. We're noticing that as our team go out looking at homes for open for inspection. What about the rental markets? What's happening to the rental markets around Australia, Andrew?
Well, look, quite interesting, Michael. The rental markets have still more or less remain quite tight in our capital city markets. We've seen a significant easing of vacancy rates in the Sydney market really over the last 6 months. Vacancy rates in Sydney are now over 3%, and obviously they're higher for units. Now, no surprise, we have a lot of stock that's come into the market. That's creating more supply. But of course, we've also seen a surge in first home buyer activity, which has seen a decline in demand for tenanted properties from that group. And of course, the consequence of those easier vacancy rates, higher vacancy rates, is rental declines. We're now seeing both house and unit rents in Sydney moving around about that $500 a week medium asking rent mark. So a much better environment for tenants in Sydney, a bit tougher for landlords, and price and rents are moving down. But that actually means that yields are starting to rise. The other markets, by and large, are quite positive for landlords, still a bit tough for tenants. We've seen the Brisbane market continue to improve on the back of strong migration. And an easing in migration has also been part of the story why the Sydney market has vacancy rates have risen.
So another interesting month in property in Australia.
Yes.
It'll be interesting when we get together at the beginning of June to see what's going on, because the tide is turning, green shoots are coming up, but it's going to be slow. It's not going to happen suddenly. But when you look back in 10 years' time, you're going to look back and say, hey, look how cheap property values were around Australia. A good time to get in counter-cyclically. Doesn't mean that the bottom is there yet, but I think the downside is limited and the upside's much more, Andrew.
That's right, Michael. And I think sellers would be a little bit more, if you're selling your property, you wouldn't be as worried about the prospect of a sale now as you were a week ago or 3 weeks ago. So it changes the dynamic, and it's all about that individual proposition. So buyers who had absolutely the whip hand in most transactions recently, not such a strong hand anymore. So you should think about that when you're making your decision, that it's, the aggregated market, the whole market, that's one thing. But when you're dealing face to face with someone, that's a whole different ball game. And perhaps now it's time for the buyer to blink after the seller's been blinking for quite a while now.
Good way to finish off that there isn't one property market in Australia. There are multiple markets, and you're not buying the market, you're buying an individual property in the market, or that you're going to want to live in the long term or invest in the long term, and make your decision that way. Thank you very much. Look forward to
Thank you, Michael.
Next week, Andrew.
Thank you so much, Michael.